All right, let's dive right into today's explainer and tackle the big, fundamental question of how to actually invest smartly. For this session, I'm going to step into the role of your personal financial advisor. Our goal here? To translate all those abstract financial concepts into a rock-solid, concrete plan by structurally defining your investment risk level. We want to set it up so you absolutely never hit the panic button during those inevitable market swings. We're going to unpack some really fascinating stuff, showing that your risk tolerance isn't just some built-in personality trait. It's a calibrated setting. Let's get started. So, we start with the story of Nathan. He's an investor highlighted in our sources, and his story is so relatable. When the markets were soaring, Nathan felt incredibly bold. He's thinking, why even hold bonds? They're way too slow. But the second the market suddenly dropped and the headlines started screaming about a crisis, Nathan panicked. He sold his stocks. Basically, he let his wildly fluctuating emotions, rather than his actual long-term timeline, dictate how he invested. He was essentially changing his risk level the same way you'd change your clothes depending on the weather outside. Here is our roadmap for today's workshop. We'll quickly cover the emotional trap, review some investing basics, explore the thermostat analogy, walk through the 6 steps to actually set your dial, and finish with a bulletproof defense player. Part 1. The emotional trap. Let's look at exactly why Nathan kept toggling his strategy. To really understand why Nathan struggled so much, we have to recognize that he wasn't being irrational. He was just being human. But that exhausting emotional toggling forced him to buy high when he felt great and sell low when fear completely took over. Human nature literally pushes us right off the tracks. So the absolute crucial point to remember here is that your objective is not to maximize short-term spectacular returns. Not at all. Your goal is simply to stay in the seat long enough to let compounding do its magic. If you jump off the train at the first sign of turbulence, you are never going to reach your destination. Moving on to Part 2, Investing Basics, Building the Foundation. Before we can even try to fix the problem with our emotions, let's strip away all that confusing financial jargon, okay? We need to make sure we both understand the nuts and bolts of a portfolio. Asset allocation is the absolute foundation of everything we're talking about. It's simply the structural balance between growth-focused stocks, which, yes, are prone to wild swings, and stability-focused bonds, or cash-like assets. Those grow a lot slower, but they smooth out the ride when a massive storm hits the market. And closely tied to that is volatility. In the real world, this means market fluctuations are absolutely guaranteed. It's not an option, it's a certainty. But, and this is the absolute most important part, letting those fluctuations actually knock you off your long-term course, that is completely optional. This contrast brilliantly illustrates the difference between two totally different things. On one side, you've got your emotional capacity. That's the pure stomach-dropping psychological pain you feel when looking at big red numbers in your account. On the other side is your financial capacity, the cold, hard mathematical reality. This includes your time horizon, your safety net, your stable income. The crazy thing is, very often, our mathematical capacity to take risks is way, way higher than what our stressed-out brains will actually allow. Part 3, the thermostat analogy, finding your comfort zone. Let's move to a mental model that everyone has right in their living room. It perfectly bridges the gap between abstract finance and your everyday life, your house thermostat. Look, if you set your investment risk way too high, cranked up like a sauna, you're going to panic at the first drop and constantly fiddle with it. But if you set it too low, like a freezer, you unnecessarily sacrifice long-term growth just for the illusion of peace. What we're looking for is room temperature. Notice how this concept maps out across a really concrete spectrum here. It clearly shows that investing isn't about slapping on some vague label like, oh, I'm aggressive or I'm conservative. No, you simply occupy a specific position on this calibrated dial. Your job is finding the exact setting that balances your expected growth with a level of volatility you can actually stomach on a bad day. Part 4, 6 steps to your dial. Let's get into the workshop. All right, time to roll up our sleeves. The source guide outlines these 6 practical exercises to lock in your exact proportions. We start by aligning risk with your timeline. Why? Because a longer horizon, like say decades until you retire, literally absorbs market volatility. So first you define the time. Then you imagine a real market crash to stress test your emotions. After that, you physically pick your setting, write it down, establish a yearly review, and finally, schedule your specific purchases. It's a true step-by-step process. To visualize this simply, let's look at a straightforward example. A patient investor who has decades left before retirement might choose this exact 80-20 split. This provides enough aggressive growth potential for the future, but it's balanced with just enough bonds to ensure a good night's sleep and a feeling of stability today. And right here is the crucial fourth step from our list. Writing out a simple, premeditated statement like this isn't just some boring formality. It acts as an unbreakable contract signed with your future self. Literally, that piece of paper protects your entire plan on the day the news declares the sky is falling, and you feel that sudden, overwhelming urge to just sell everything.
Part 5, the defense plan, surviving the drops.
Since we have a plan, we absolutely need to stress test it against the inevitable bad weather. Behavioral research proves something really fascinating. It's a concept called loss aversion. Basically, the psychological pain of losing $100 is significantly stronger than the joy of gaining that exact same amount. And the historical charts, they don't lie. Diversified global stock markets routinely experience declines of 20 to 30%. The golden rule here is to choose an allocation that you are completely confident you can hold through exactly this kind of drop without hitting that panic button. When the market inevitably turns red and the headlines start screaming about recessions, your job is to pull out this self-talk script and, read it out loud. Seriously, reading it out loud actively helps bypass those frantic emotional reactions and restores your logical thinking. It reminds you that the current discomfort you're feeling, it was already priced into your strategy from day one. Which leads us to our ultimate golden rule for today's explainer. Let your structural, cold realities, like your time horizon and your actual financial capacity, drive your decisions. By doing so, you secure all the incredible financial benefits that come from being a patient, long-term investor. It really is a game changer. I want to leave you with this final, provocative thought. Look at your finances and your investment plan right now, today, and ask yourself this key question. What decision, made today without emotion, will make the future version of you incredibly grateful 20 or 30 years down the line? Set your dial wisely, stick to the plan through the storms, and you'll get there. See you next time.